This is the Chapter 10 exam review of the most missed questions. Question number 1. They want to know the average cost to produce 1 unit, and the way we figure that would be you take the product cost in manufacturing companies is always going to be equal to 3 things: material cost, labor cost, and overhead cost. You add all those together, divide by the number of units produced, and that's when you're going to get the average cost to produce 1 unit. So in this problem, we've got $31,750 worth of direct materials. We've got $18,500 worth of wages. That's direct labor wages for production workers. And then we've got $7,500 worth of factory overhead, and the way they explain this is lease payments and utilities on the production facilities, and those are things inside the factory, things going on inside the factory. So when you're trying to figure out product cost, what you're trying to look at is things going on inside the factory: materials, direct materials, labor, and everything else going on inside the factory is going to be overhead. If it's not material and it's not labor, then it's overhead. So we've got those 3 costs divided by 5,500 units, which gives us looks like total production cost would be $57,750 divided by 5,500 units, and so the average cost to produce 1 unit is $10.50. Second question. They want to know the average cost to produce 1 unit. They give us that, which is $4.90. They want to know how many units were produced during the period. So if they give us the average cost to produce 1 unit, which is $4.90, how many units were produced? All right, so this little formula is that production cost in manufacturing equals the 3 things: material cost, labor cost, and overhead cost, and you divide that by the number of units produced. And in this case, we know what the average cost per unit is, which is $4.90. We also know the individual unit total cost of these items, which would be $28,810 for direct materials, $49,900 for direct wages, that is wages inside the factory for production workers. And we also know the overhead, which again, if it's not material and it's not labor, then it's overhead, which is $13,900. And we know that if that $4.90 was the product of those 3 pieces together divided by the number of units produced, then we can take $4.90 and we can say that that's equal to $92,610 divided by some number of units. So we can take the $92,610, divide that by $4.90, and we'll get 18,900 units. So we're kind of working this as backwards from the last problem. Third question. They want to know what is XYZ's cost of goods sold for the year. Okay, cost of goods sold, the first thing you have to figure out would be, in this situation, the product costing and manufacturing is going to be equal to these 3 pieces: material, labor, and overhead. And you divide that by the number of units produced, and that'll give you the unit, the cost per unit. But again, they want to know cost of goods sold for the year. And so we're going to figure out first this cost per unit, which is the material cost, $11,360. $11,100 would be the wages for the workers, that is inside the factory, that are touching the product, which is direct labor, and $10,100 for the overhead, which again is, they just described this as lease payments and utilities on production facilities. Production facilities, that's what's really key here. And you divide that by the number of units produced, which is 7,400, and you get $440 per unit. And then the cost of goods sold, which is what we're looking for here, is number of units sold times the product cost per unit. In this case, it'll be 4,600 units that were sold. They gave us that they produced 7,400 units and they sold 46. And the cost of those units that they sold is called the cost of goods sold. So the 4,600 units that they sold times the 440 per unit cost that it costs to make each unit gives you a total cost of goods sold of $20,240. Next question. They want to know what is the amount of gross margin for the first year. Okay, gross margin. The first thing we're going to do before you figure out gross margin, by the way, gross margin is the sales minus the cost of goods sold. That equals gross margin. So sales minus cost of goods sold equals gross margin. But first we have to do some calculating to get to that point. So we're going to go back to our old thing we've been looking at since we've started reviewing this, which is product cost, which are materials, labor, and overhead, divided by the number of units produced. So materials, direct materials were $7,000. That's direct materials were $7,000, and we have $9,500 for labor. Direct labor is $9,500, and then we have overhead, which is $8,500, which was also given to us. So now we can take and find the cost of goods sold, which would be in this case. It says here in the problem here that they produced 5,000 units and they sold 3,000. So we'll take the 3,000 that they sold times the cost per unit, which we figured out right above here, and the cost of goods sold is 15,000. Remember up here I said that sales minus cost of goods sold equals gross margin. Well, you can take that formula, that revenue, which is sales, minus cost of goods sold, and get gross margin, and we can plug in now some things that we know. We know that they sold these 3,000 units at a price of $750 a piece, so we can find out total revenue by taking 3,000 that we sold and multiplying that times $750, and then subtracting off the cost of goods sold that we figured out here before, and so total sales or total revenue minus 15,000 should give us gross margin. So the total sales or total revenue were $22,500. That's sales minus the cost of goods sold, which is $15,000. That gives us gross margin of $7,500. Next question. They want to know what is the amount of finished goods inventory on the balance sheet at year end. Finished goods are something that when you make several items and you don't sell all of them, then you end up with finished goods. So let's see what we've got here. First thing we're going to do again is figure out the cost per unit that we were making these items at. So it's going to be the total product cost will be the material cost plus labor plus overhead divided by the number of units produced. We've seen this lots of times. So the materials that we use to make these products, that's direct materials. We spent $10,000 on those direct materials. We spent $11,500 on wages, that is direct labor, so that's $11,500. And then it looks like we also spent $10,500 on overhead cost. Now we made 8,000 units and we sold 5,000 of those units, and we sold those at a total retail value of $6.50. So now we're going to figure out, let's see, we sold those, and okay, so now let's go to our next step. So the unsold units we have here, if we made 8 and we sold 5, we must have 3,000 unsold units. That is, we produced 8,000, we sold 5,000, so 3,000 we still have left in ending inventory, which is what this is. Now we're just going to take that number, which is the 8,000 we made, minus the 5,000 that we sold, that's 3,000, times the cost of those units that it cost us to make them, and that'll give you what the ending finished goods inventory will amount to. In this case, the ending inventory was like 8,000 minus 5, which is 3,000, times $4 per unit, or finished goods inventory should be 12,000. Next, they want to know what is the XYZ's net income for the first year of operation. All right, first thing we're going to do is figure out the cost that we had for these units, and we've got material costs. In this case, are $16,360 for direct materials, and we've got $10,300 for direct labor. That is $10,300 for production wages, workers' wages, which is again direct labor. And our overhead is going to be $9,300, which is going to be that number up there. And so we'll take all three of those, add them together, divide that by the total units that we produced. The company produced 6,200 units. And when we do this, we'll get, that's going to be $5.80 for the cost per unit. Now, again, we're looking for net income. So the next thing we're going to do is we're going to figure out the cost of goods sold. Now, there may be shortcuts to this, working this problem, but I'm going through all the steps that I would go through in a normal situation to show you all the pieces, and then we'll find out what we're looking for, which is the net income for the first year. So in order to get cost of goods sold, you want to take the number of units that we sold, and so it looks like we made 6,200 units and we sold 3,800 of those. And that 3,800 we'll put in here, multiply it times the cost per unit, which is $5.80, and this will give us the cost of the units that we sold, which is $22,040. So we now have cost of goods sold, and to get net income, we want to take revenue, and that'll be the units that we sold times the selling price of $8.30. That'll be total revenue. The cost of goods sold we've already got, which is $22,040, which is cost of goods sold. And then the other expense to come to net income, which is below the gross margin line, will be the selling and administrative expenses. And in here they told us that selling and administrative expenses total $4,800. So now we've got enough to solve this. So we can say that the revenue, total revenue, amounted to 3,800 units. That's how many we sold, times $8.30 per unit. That's the selling price, minus the again the 3,800 units that we sold times their cost, which is $5.80 per unit. Also minus the selling and administrative expenses, which are $4,800. You crunch all that in your calculator, and here's what you come up with: net income. That's what you come up with, and that's going to be revenue, $31,540. minus the cost of goods sold, which is going to be $22,040, minus the selling and administrative expenses, which is $4,800. So net income is equal to $4,700. Next question. They want to know what allocation rate should be used if the company incurs overhead costs of $18,620. All right. Whenever you figure out overhead allocation rates, you want to keep the following things in mind. The company's overhead costs are driven or affected by the number of direct labor hours, because the production process is very labor intensive. So we have figured out that there's a real close connection between how much we spend on our overhead versus how much direct labor we have. We've figured out those two relate to each other very closely. So keeping that in mind, then we should try to come up with an allocation rate for overhead based on labor hours, because that seems to be something that's very, very tightly wound together. Those two things correlate very closely. So based on that, we're going to say that we can figure out an allocation rate for overhead, that is how much we used overhead by, how much we're going to put overhead into our process by taking the overhead costs that we have and dividing that by the allocation base. In this case, it should be labor hours. So we're going to say that the allocation rate, which is going to be the total overhead we spent, which is $18,620, that's in the problem up here, says that during this period of time we've got, let's see, direct labor or labor hours of 790, and we've also got that would be for product A, and we've got 190 hours that we spent on labor for product B. So the total hours of labor that we spent, we're going to add those two together. We're going to divide that by the total we spent on overhead, which they just gave us. That is what the allocation rate should be used if the company incurs, that is spends, that much overhead, that which would be $18,620. So when we do that, what we find out is that $18,620, that's how much we spent on overhead, divided by the total labor hours that we incurred, which are 980, means that every time that we have, in this case, spend labor, we should allocate $19 to overhead. So let's go to the next question. All right, so we've got all this information here, materials, wages, salaries, depreciation, rent, packaging and shipping, sales revenue, units produced and sold, 18,100, selling price, $19. And from all this, they want to know what is the company's cost of goods sold. Okay, cost of goods sold. That would be taking the material, labor, and overhead that's incurred in the factory and figuring out how much we have spent in terms of making these units. So we'll do that. And then we've got material cost of raw materials used, $18,100. We've got direct labor, which also was incurred inside the factory, which is $38,100. And then we've got overhead, which amounts to anything else that's going on inside the factory that's not material and that's not labor. Well, sales, salaries, and commissions, that's not something going on inside the factory, so we don't count that. But we do count $2,810 for depreciation, which we've got that down here. And we also count rent on manufacturing facilities. That's something that's part of the factory. So it's $23,100. Those two things are considered overhead cost. In this problem, packaging and shipping expenses, they don't consider that in this situation as something going on inside the factory. It's maybe going on inside a warehouse or something, but not inside where we actually make the product. So you don't want to count that. Other books might include that, but we're not going to include that in this situation. Anyway, you take all those costs divided by 18,100 units, which is how many units we made, produced, and sold. And when you do that, take all those costs divided by 18,100 units, you get the cost per unit, which is $4.54. Now, this problem wants to know what is the cost of the company's cost of goods sold. Well, the cost of goods sold would be how many units we sold times the cost per unit. Well, the cost per unit was $4.54, and the number of units sold was 18,100. So the cost of goods sold will be $82,110. Now, I've already said this before, but I think I'll repeat this, which is sales, salaries, and commissions are not included in the cost of goods sold because they're not something that's going on inside the factory. Now, this packaging and shipping supplies, like I said, that's something that in some situations, depends on the real world situation. If those things are going on inside the factory, that is inside where you're making these items, you'd include those also. But this particular book and this particular situation has decided not to include those as part of something that's going on inside the factory. So therefore, we don't include them there. Okay, next question. We have a set of information here. We've got raw materials, labor, sales, salaries, depreciation, rent, administrative supplies and utilities, sales revenue, units produced, units sold, and they want to know what's the company's net income. Okay, net income, we're going to take all of the cost, first of all, that are product cost, and we're going to figure this out just like we would, just like we make an income statement up. So we're going to take all the product costs, which were $16,000 for material, $32,000 for labor, direct labor, and then the overhead pieces, which were $2,900 for depreciation on something inside the factory, which is production equipment, $2,900. That's a cost. And $3,900, which is the rent on the factory facilities. That's again something that's related to the factory, $3,900. We're not going to include administrative supplies because that's in the office, and we're not going to include sales, salaries, and commissions because that's also outside the factory. All right, so got all those costs that related to something inside the factory. Divide that by 3,000 units. That's how many we produced and sold, and that gives us a total product cost per unit of $18.27. Now remember, we're trying to get net income. Now again, there's probably shortcuts to this, but I'm going to show you the whole thing just like I was putting together an income statement. So to get the cost of goods sold, we're going to take the number of units that we sold, which in this case was 33,000, times the total product cost per unit, which was $18.27. And our cost of goods sold is going to be $54,800. That's the 3,000 units that we sold times the cost per unit of $18.27. Gives us a total cost of goods sold of $54,800. And now we're ready to put together this entire little piece of information, that's all the pieces for net income. So net income is going to be the result of taking revenue minus the cost of goods sold minus selling administrative expenses. So here's our net income. It's going to be revenue of $95,000. Our sales revenue, $95,000, minus the cost of goods sold of $54,800. We figured out the cost of goods sold earlier, $54,800, minus selling and administrative expenses. Remember, those things that are not inside the factory are somewhere else outside the factory are considered selling and administrative expenses, or selling administrative. So we've got sales, salaries, and commissions, $24,000. That's that, and then $4,000 for administrative supplies. And when you combine all those things together, you get net income is going to be $12,200. Now, again, why wasn't sales, salaries, and commissions included in the cost of goods sold? It's because it wasn't going on inside the factory. Same thing with administrative supplies and utilities. It's not going on inside the factory, so therefore it's not part of cost of goods sold. Next question. We are given the following information. We're given wages for machine operators, $260,000, and wages for selling and administrative personnel, which are going to be outside the factory, $71,000. We're also given materials used, and they tell us that lubricants for oiling and machinery, for oiling the machinery was $21,000. We spent $21,000 on oil or lubricants. We also spent cocoa, sugar, other raw materials, $210,000. So we must be making candy bars or ice cream. We must be making something that uses sugar and cocoa, chocolate ice cream, something. $210,000, and also packaging materials of $150,000. And they want to know what would be XYZ Company's direct labor costs. Well, direct labor costs are something going on inside the factory. So it'll be $260,000 of wages. That's it. So this is pretty easy when this one was. Now let's take a look at our last question here. Oh, before we get to that one though. The wages of $71,000, right here, selling and administrative personnel, $71,000, that would be classified as a period cost. You know, there are product costs, which go in the cost of goods sold, and there are period costs. A period cost is something that goes below the cost of goods sold section as a regular operating expense. So they're considered period costs. All right. Our last one here, they want to know what would be direct materials. How much is going to be direct materials? So we're given wages, you know, of inside the factory, outside the factory. We're also given materials used, and so we're given lubricant for oiling machinery, $15,000, cocoa, sugar, and other raw materials, $150,000, and packaging materials, $90,000. Now this is a tricky question. It might be considered a question that's a little bit maybe I don't know, misleading or whatever. It is for sure that we should conclude cocoa, sugar, and raw materials, $150,000. That's a given. That's for sure. These next two are a little bit iffy. The rule of thumb here is that you should consider a direct material that's anything going on inside the factory that's easy to measure and that you can pretty much touch as part of the product. Like if you're making desks, wood would definitely be something that would be considered a direct material. Now, lubricant for oiling machinery, that's possible that you could consider that like an indirect material, something that you're not going to sell the oil that you're using to lubricate the machinery. You're not going to sell that to the customer, but you do need it to keep the machinery running. That's one way to look at it. Just like the packaging material. The packaging material is another one of these iffy, questionable kind of things. Packaging material, if you're making, let's say, ice cream, let's say this is all for ice cream. If you're making ice cream, then you absolutely got to have the cartons to put the ice cream in to sell to the customer. It's something ordinary and necessary to sell it to the customer. So in that respect, that would be considered part of the direct materials. Now, I'm not sure what your answer for your book's going to be, but whatever it is, we want to make sure that we get this question right on the test. So we're going to use the same logic that the book uses for this question, so that you can use that same approach and not get this question wrong, regardless of how it might be in the real world. So here we go. Now, like I said before, this question is the test question, and it's probably a bad example because you could argue that packaging material is probably direct material, and you could probably argue and probably say, and like I said, I'm not sure how it's going to treat this 15,000, but we'll see in a second. So the answer to the question is this: direct materials include the cost of materials that can be easily and conveniently traced to the products, such as the $150,000 cocoa sugar. So that for sure is direct materials. They didn't include the lubricant as direct material because, again, that's not something you're actually selling to the customer. That's something you need as an indirect material going on inside the factory to keep the machines running so you can make the product. So that's the answer. The answer that they want for this problem, and you can do the same methodology, same thinking, would be $150,000 is what the total direct materials are. And that's the end of this review.